Okay, so let's talk about earnest money. What is earnest money? How does it work? What does it look like? Sometimes it's a little bit unsettling for people to think, I haven't purchased this home and I've got to give cash towards the purchase. I mean, the simplest and easiest way of explaining it is a deposit. It's a good faith deposit saying you intend to complete this transaction. When a seller puts a home on the market, they're looking for as many buyers as possible to come and look at their home, and they're looking for the person that will pay them the highest price. Obviously, we want to just pay the market value. Sellers are intent on getting the most value. Buyers intent on getting it for the best price. And we help navigate both of those competing desires. The seller, when they do accept an offer, they now have taken their home off of the market. So that means that nobody is continuing to look at the home and that they're maybe turning away potential buyers. So when a buyer gets under contract, they're asking the seller to enter that escrow period and that time when their home is not marketed for sale. And so they ask for what we call earnest money in exchange to take their home off the market and not market it to any other buyers. Essentially, you're locking the home into your name. Now, earnest money can be a very small amount. Sometimes it can be a very large amount. In a non-competitive situation and non-competitive market, earnest money is a little bit less. You can give earnest money in what's called a promissory note. So you're just saying, I promise this amount of money to be there if for some reason I default on this contract. That's very uncommon, but could happen. The most common stipulation and where the market typically works, earnest money is 1% of the purchase price. So if you're buying a $250,000 home, then the earnest money is going to be $2,500. For a $500,000 home, it's going to be about $5,000. In competitive market situations, and when you have a buyer who has financial health and is a very strong buyer, it's common for us to increase that to 2 or 3% of the purchase price. So just for example's sake, let's say somebody's going to purchase a $700,000 home and they're coming with 20% down, which is $140,000. They obviously have a lot of cash in the bank. They may say, we'll give $21,000, so 3% of the purchase price as our earnest money. And that really just sends a strong message to the seller that you are very serious and you intend to complete the contract. Now, this earnest money is protected, okay? So very important to understand that it's not just a good faith deposit and it's gone. It's protected by your contingencies in the contract. So if you go do your inspection and you find that the house is falling apart, the foundation's crumbling, you can terminate the deal and get your earnest money returned to you. You would lose the money, the cost of an inspection, $500 or so, but much better than buying a home that's falling apart on itself. You're also protected by other contingencies, multiple other ones. Most importantly, again, being the appraisal process and the financing contingency. If you got to the end of the purchase and you unfortunately lost your job and the bank's going to no longer give you a loan, that'd be a really pretty sad day, we could all admit, and you would be able to terminate the contract and get your earnest money back. So it isn't just gone or wasted. Also, it's not an additional payment. So that earnest money gets applied towards either your down payment or your closing costs. So we advise people that typically on a conventional loan, kind of the minimal is 3% down. You also have probably about 3% in closing costs. So in a purchase of a $500,000 house, you're looking at needing kind of at minimum $30,000. Now, if you gave $5,000 towards your earnest money, on the day of closing, you need your down payment and your closing costs, which we estimate to be about $30,000. It'd be less the $5,000 earnest money. So you'd only need to bring $25,000 to the table. So that earnest money is not wasted. It doesn't just go out into thin air. It gets applied towards the cash required to close the deal. Earnest money is a very effective tool in the buying and selling process. A buyer, the one way you can lose your earnest money is that if you clear all of your contingencies in your contract and then you just kind of panic at the end, at the last day, I don't want to buy this house, and you have no reason to not complete your purchase, like contractual contingency to protect you, in that scenario you would forfeit your earnest money to the seller. And that's just what it's there to protect, that you don't take up all the time for the seller, and then cancel the deal. So earnest money, that's the breakdown of how it works. It sounds complicated, but it is rather simple. I hope that explains it a little more.